Hey, welcome to The Explainer. Today, we're going to break down one of the most important, but honestly, often overlooked numbers in your entire financial life, and that is your debt-to-income ratio. So let's just dive right in, because really, getting a handle on this one number can be the key to hitting some of your biggest financial goals.
So, picture this. You've been saving up for that down payment. You've spent months, maybe even years, scrolling through property listings, and you finally find it, the perfect home. You go to apply for that mortgage, you're feeling pretty good about it, and then you get the news. You're denied. And the reason? Well, it's a number you probably weren't even paying attention to.
It is such a frustrating story, and it happens all the time. So what is this secret number? It's your debt-to-income ratio, or DTI for short. And you've got to understand, for lenders, this number tells them a crucial story about whether or not you can handle taking on new debt. So let's pull back the curtain and see exactly what it's all about.
Okay, so what is it exactly? Your DTI ratio is just the percentage of your gross monthly income, and that's your income before taxes are taken out, that you use to pay off your monthly debts. We're talking student loans, your car payments, minimum credit card payments, all of it gets added up. The math is actually pretty simple. You just divide your total monthly debt payments by your gross monthly income. So say you have $2,000 in debt payments each month and you bring in $6,000 gross. Your DTI is 33%. See? Simple, but its impact is absolutely huge.
All right, now that we know what it is, let's get into why it is so incredibly important to lenders. Why is this specific calculation their go-to number?
Well, here's the deal. Your DTI is basically the main tool lenders use to figure out their risk. It gives them this really clear snapshot of your current financial promises versus your income. It answers their single biggest question. After you've paid all your other bills, can you really, truly afford this new house payment?
You know, lenders kind of see your DTI in different zones. Ideally, what they really want to see is a ratio below 36%. That's the green light. That tells them you can comfortably handle more debt. Now, between 36 and 43%, you still might get approved, but maybe not with the best interest rates. But once you get above 43%, well, that's when it starts to get pretty tough.
And that 43% number isn't just some random preference, it's a major benchmark. Under the Truth in Lending Act, for a lot of standard home loans to be considered a qualified mortgage, which is just a type of loan that has safer features for you, the borrower's DTI ratio generally can't be more than 43%. So for a huge chunk of the mortgage world, that is a hard line in the sand.
Okay, so what if your DTI is a little higher than you want it to be? Don't worry, you are not stuck, not even close. This number can change, and you actually have the power to change it. So let's focus on 3 really clear, actionable ways to do that.
Here's your game plan. First, find your smallest loans and just focus on paying them off completely. When you get rid of even one small monthly payment, it's totally gone from the DTI calculation. Second, look into refinancing some of your existing debt, like student loans, to see if you can get a lower monthly payment. And third, you can tackle it from the other side of the equation and work on increasing your verifiable income. Let's actually zoom in on that second strategy for a minute, refinancing, because this one can have a really powerful and fast impact. Just a small change in what you pay each month can make a huge difference in your overall ratio. Okay, check out this example from our research. Let's say a person makes $50,000 a year and has a $30,000 student loan. Before they do anything, that one loan makes up 9.5% of their DTI. But by refinancing to a longer term with a lower interest rate, their monthly payment drops and the loan's impact on their DTI plummets all the way down to just 5.7%. That is a massive improvement from just one move. So why go through all this trouble? What's the real payoff? Well, it's not just about getting a lender to say yes, it's about changing the kind of yes you can get.
This quote right here really nails it. Every single percentage point you can shave off your DTI directly becomes more purchasing power for you. A lower DTI means lenders look at you and see someone who can afford a bigger monthly mortgage payment. And what does that mean? It means a bigger housing budget, which could put a whole new level of homes on your radar.
So at the end of the day, you have to think of your debt-to-income ratio not as some grade you got on a test, but as a tool. It's just a snapshot of where your finances are right now. And just like taking a new photo, you can absolutely change the picture. Once you understand the pieces and know which levers to pull, you are in control. So we want to leave you with this question to think about. When you look at your own finances, that small personal loan, that credit card with a high interest rate, that side hustle you've been thinking about, what's the very first step you can take starting today to lower your DTI and get closer to that big goal. Thanks for watching.